Hey guys, how you doing? So Dan from Trading with Dan here. So I just wanted to do a quick video outlining two of the next dominoes that I think we've got to fall over in the current financial system. Two of the next issues that we're going to have to deal with large scale. The first of those is credit downgrades. So we've had Ford basically had its its debt, its credit cut to junk. So obviously that means it will incur a higher cost of borrowing if it can actually refinance the debt at a price they can actually afford to anyway. So that's obviously not good for Ford. So yeah, I'll quickly read through just a little bit of this. Ford Motor Company was cut to junk by S&P Global Ratings as the pandemic delivers a shock to the global auto industry and renders the car maker the largest fallen angel due to date. S&P downgraded Ford's credit rating one notch to BB+ and may cut it further, according to a statement. The move follows Moody's Investors Service, which dropped its rating for the second time in 6 months earlier Wednesday. The automaker's two high yield ratings will remove its 35.8 billion of debt from Bloomberg's Barclays investment grade index at the end of the month. So obviously that's because their debt is no longer investment grade anymore. It is what is known as junk basically. So yeah, so that's their second downgrade they've had from Moody's, and the first one by the S&P Standard & Poor's. So yeah, we also had Exxon. Exxon had a downgrade from AA to AA from AA+, and they're also threatening these guys with another grand downgrade too. And then obviously I think I spoke about this in another video. Exxon actually did also borrow another I think it was 8 billion from their revolving credit facility, which is basically a credit card. So I think they're definitely going to get another downgrade, so no wonder they're trying to take the extra debt whilst they can get it. Not that is the most efficient form of debt for them to get. And then also, as also we know, Boeing was cut by S&P Standard & Poor's, and Moody's, but obviously that's to do with their 737 Max debacle. But a lot of these guys though, these rating agencies, they basically are asleep at the wheel, these guys anyway. They should have downgraded a lot more companies, a lot more than they have done so far. But they're part of the facilitation process of the whole system. These guys basically just give companies higher ratings than they should do, so they can then get more debt financed at a better level. So that's the first domino. Credit, we're going to get a wave of these credit downgrades. So that's going to cause obviously a big problem for funds that can't hold like debt that say isn't investment grade. So they'll have to dump it. And yeah, so that's obviously another domino. And then the second one, this is a big one as well. The Cheesecake factory says it will not be able to pay rent for any of its storefronts from the April the 1st, and I don't think they are going to go and say surprise. Just kidding. April Fool's you. I don't think they're gonna. I think they're being serious, guys. Yeah, so this is in the Hill. So yeah, the Cheesecake factory says it will not be able to pay rent on its nearly 300 storefronts come April the 1st due to loss of income it sustained during the coronavirus outbreak. So this obviously commercial rents that are then obviously the debt attached to them, that's percolated its way around the system, around a lot into people's pensions via REITs, real estate investment trusts. These are basically going to be defaulting. So the implications of that for the world capital markets is obviously massive. And yeah, I mean, it's just another kick in the teeth for the high street, where you've also got Amazon basically eating everybody's lunch on the high street. Amazon actually, ironically, have then picking up these malls really cheap when they basically shut down, and using them as distribution centers, obviously closer to their customers. So yeah, it's not an ideal scenario at the moment. Well, just in the market, full stop. Obviously that's going to cause, I mean, the 2008 financial crisis was caused by people not paying their mortgages back. I mean, what's going to happen when commercial real estate isn't basically going to pay its rent, pay their rent? So it's not a good outlook, guys. These are two major dominoes that are basically in the process of falling, and yeah, it's gonna there's just a lot of implications of this. So yeah, I wanted to get that out there to you guys. So the credit downgrades and yeah, they're not paying enough rents. I mean, these are obviously all things that are going to happen when the economy literally shuts down. I mean, a business can't just keep paying when it's not getting any cash flow. I mean, not many businesses have cash piles these days, because a lot of them used it just to goose their share price with share buybacks, which obviously wasn't the greatest idea, especially based on the price that they bought those shares back at and what the shares are trading at now. Definitely didn't turn out to be a good investment. But anyway, yeah, so that is something for you guys to keep an eye out, because it is going to play a part in the weeks to come. So yeah, that obviously coupled with we had the worst jobs number ever, basically. Let me see if I can find you guys just a chart of the jobs number, so you can literally see how totally ridiculous it is. Just 1 second and I will get this over for you. Just 1 second, guys. Apologies for the delay. Here we go. So this is the jobless claims number. So these are basically where jobless claims has been since 1967, and yes, they've obviously they've been around these levels. Obviously we had peaks around here, obviously 2008. So obviously 1987 wasn't a real jobs crisis, but yeah, I mean, that looks like if I saw that on a chart, I would think that was an error. But that isn't an error, and I would imagine this is obviously going to get a lot worse, and this is probably understated as it is at the moment, with people not opening claims yet, and obviously what's going to be going forward. So this is ridiculous. I mean, GDP is going to be slashed, the GDP numbers. Things are a mess, guys, and there's people out there that are just thinking, right, this is buy the dip time in stocks. I mean, we had a bit of a rally, but yeah, we'll see what happens with that, because you guys know what I think. This is basically whack-a-mole with the stock market for the next few years. Just sell the bouncers. Anyway, so it's not a financial advice. I'm not a financial advisor. Always do your own research, and I will speak to you guys later.